Good afternoon, everyone. Welcome back to this week, the 17th of March weekly market review. As usual, today I have with me Gerald. How are you, Gerald?
Very well. So now we are into the middle of March. The markets have been very volatile. We have seen some sell-off in the US market, and likewise last week the Singapore market also pulled back. So looking at what is ahead and trying to understand then what to do with my portfolio.
Yes, statistically speaking, February has always been one of the worst performing months during the year, but March is one of the top three performing months in the year as well. So we are still waiting to see if the rebound last Friday that we see on the US market will likely sustain or will weaken further. So there are also developments on the Singapore markets. There are some significant pullbacks on the banks as well. We could be an opportunity and gives you some very attractive yield coming up. And Gerald will be talking about some of the REITs today as well, which could help you diversify your portfolio further and build a more resilient portfolio for your retirement. So without further ado, I think I'll let Gerald take over for now.
Hey, thanks, Sunny. As usual, the usual disclaimers that today's sharing is for information purpose only and should not be taken to be financial advice. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website, sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, I will start with a recap of the market in the past week. We see the S&P 500 having a further decline, 2.3% for the week, despite a bounce on Friday. So we are looking at a pullback of close to 10% from its recent peak. And we see that the sell-off is quite broad-based across the tech stocks as well as the industrial stocks. And that is actually weighing on the US market. Okay, the STI has been outperforming in the past weeks, but the sell-off has actually caught up with the Singapore market, falling by 2% in the last week to now below 3,900 points, closing at 3,836 points on Friday. Okay, so what is driving this pullback in the market? We mentioned last week that one of the key data points we'll keep a lookout for is the US inflation data. The US Consumer Price Index data for the month came out at 2.8%. That is slightly below market expectations and also moderating from what we saw in January. But despite this, the market actually had a sell-off, and we'll try to find out what are some of these reasons. Okay, so I think first and foremost, we have seen a weakening in consumer sentiment in the past few months. This is really driven by the uncertainty around Trump's tariffs that is leading to consumers pulling back on their spending. Okay, so this is the consumer sentiment data that came out last week. We have seen this very sharp pullback from December, effectively close to a 20% decline in consumer sentiment over 3 months due to the uncertainty around the Trump's tariffs. Okay, so not only that, we have seen a very sharp spike in the inflation expectations. So this is actually the 5-year inflation expectation amongst US consumers. And I've actually put out a 5-year data set here. What this is meant to show is that not only has it gone up very rapidly in the last few months, effectively, this is the most elevated level over the past 5 years. So I think that is driving the concerns around whether we are going to see a potential slowdown in the US economy or potentially even a recession. Okay, so how has that translated to the Singapore market? We see that there has been a divergence in terms of the share price performance. Even though the STI was down by 2% last week, actually there were some names that did very well. So the Jardine related names, Jardine Matheson and DFI Retail Group, up by 7% and 9%. Okay, we also saw the REITs having a bounce. Fraser's Logistics and Commercial Trust that we just spoke about last week, bounced by 9%. Fraser Centrepoint Trust up by 7%, and CICT up by 6%. Okay, so I'll go through two of the other names on this list today, Fraser Centrepoint Trust and CapitaLand Integrated Commercial Trust. Okay, in terms of the worst performers, we see some of the banks actually appearing on this list as the concern about a potentially economic slowdown is weighing on their stock. So DBS down by 3.8% and OCBC down by 4%. Okay, so there are two names that I wanted to discuss more about, CICT and FCT, both retail REITs with exposure towards the Singapore market. Okay, so CICT, we see this sharp bounce over the past 2 weeks from below $2 per share now to $2.13 as of Friday. Okay, so this is effectively bringing it back close to where it was in September last year. Okay, so a quick recap around CICT's DPU. What we see here is that in 2024, the DPU actually went up slightly from 10.75 cents in the previous year to 10.88 cents. Okay, so this is one of the few REITs that we actually saw some increase in the DPU in 2024. Even in the second half of the year, it's been able to keep the DPU flat at 5.45 cents compared to the second half of 2023. Okay, so one point I would like to always bring up about CICT is the diversified exposure and the significant exposure towards the Singapore market. Okay, so Singapore is about 95% of its portfolio. So unlike some of the other REITs that were impacted by weakness in the regional currencies, what is worth noting about CICT is that 95% is actually in Singapore, and this is spread between retail as well as office assets. Okay, so we see a breakdown between office, suburban retail, downtown retail, some hotel, convention, and center. So effectively a fairly diversified portfolio across different asset classes. Okay, so what do we see in terms of the occupancy across the portfolio? The overall portfolio occupancy increased to 96.7% as of December 2024, from 96.4% in September. So across different asset that they have, retail, we saw a slight uplift in the occupancy, and likewise, we saw that for office as well. Okay, if you're to look at the retail tenant sales as well as shopper traffic, we saw that it has improved in FY 2024. For the retail portfolio, the tenant sales grew by 3.4% and shopper traffic grew by 8.7% in 2024. This was further helped by the acquisition of Iron Orchard that was completed last year and had a 2-month contribution towards the FY 2024 tenant sales. Okay, we also saw positive rental reversions for the retail portfolio. So across both the suburban as well as the downtown malls, we saw positive rental reversions in 2024. So that helped the overall retail portfolio to achieve close to 9% positive rental reversion in 2024. Okay, if I were to look at the office portfolio, what we see here is also the improvement in the occupancy rate. In Singapore, that improved from 97.4% to 97.6%. And likewise, we saw this improvement in the occupancy rate in Australia as well. Some slight dip in the German portfolio in terms of the occupancy rate, but overall, we still managed to see an uplift in the office occupancy. If you're to look at the Singapore office rents, that also continued to improve to $10.73 per square foot in December 2024, from $10.49 per square foot in December 2023. Okay, if I were to look at CICT's balance sheet, it remains healthy, leverage of 38.5% as of December 2024, and an interest coverage ratio of 3.1 times. Okay, so at this point in time, with the bounce in CICT share price, price to book of 1 times, that is above the historical average, and dividend yield of 5.2%, which is close to the historical average. Okay, next will be on Fraser Centrepoint Trust, another retail REIT with significant exposure towards Singapore. And like for CICT, we saw the bounce in FCT share price in the past week, but still below where it was in September last year. Okay, so as a recap of FCT's portfolio, 9 retail assets in Singapore, and they are all in the suburban areas, effectively exposed towards some of the places with a very big household size, and where people will potentially go there for F&B, for actually buying some of the normal necessities. Okay, so what did we see for Fraser Centrepoint Trust in terms of the gross revenue and net property income for FY 2024? What we see here is that there's been some decline for the gross revenue and net property income. But this is really due to the divestment of Changi City Point and the asset enhancement that they're doing at Tampines 1. Okay, if you're to exclude this effect, then the underlying gross revenue and net property income for the remaining assets will actually see a slight improvement. Okay, what we see here for the distributions to unit holders was a slight increase of 3.2%. And overall for the DPU for FCT, it came down slightly by 0.9% in the whole of FY24 to 12.042 cents. And that is a slight contrast to what we saw for CICT, which is a slight improvement. Okay, so if I were to look at the occupancy for FCT, still very high at 99.5%, but we have seen some decline from the first quarter of 2024, where it was actually close to 100% occupancy. So like for CICT, we also saw this still continued improvement in the shopper traffic as well as tenant sales, and that has extended for the quarter ending December 2024, which is the first quarter 2025 for FCT. Okay, we also continue to see an improvement in the retail rents across both Orchard Road as well as suburban malls in the whole Singapore market, and that's actually helped FCT to be able to support its distributions. Okay, so we see here the occupancy trend for the suburban malls in Singapore remain very high, and that continues to outperform some of the downtown malls. Okay, we have continued to see improvement in the retail rents across different segments, including the downtown malls as well as the suburban malls, and that has helped to lift the overall rents for retail space in the Singapore market. According to a forecast by consultants, that is expected to improve further because there is actually a lack of new supply that's coming into the Singapore market over the coming years. Okay, so overall for the balance sheet of FCT, the leverage ratio increased slightly to 39.3% as of December 2024, but still below the 40% level, and interest coverage ratio at 3.3 times, so that continues to be fairly healthy. Okay, if I were to look at the valuation of FCT at this point in time, price to book ratio of 1 time, so quite close to what we saw for CICT, and that is above the historical average of FCT, dividend yield of 5.4%, so quite close to what we see for CICT as well. Okay, so having done the recap of the two REITs, what will we be looking out for will be the Federal Reserve meeting this week on the 19th of March, because that will give us an indication around what the Fed assesses to be the state of the US economy, as well as what does that mean for interest rates going forward. Okay, so that'll be the key thing I'll be keeping a lookout for this week. And with that, I'll hand over to Sunny, who will share with us the technical analysis.
Hey, thanks, Gerald, for that sharing. Indeed, some of the REITs are starting to show signs of a rebound, especially the diversified ones and those that have more Singapore properties coverage. So those could be ideas that could help you diversify your portfolio further in this current environment, very difficult environment that we are in now. So having said that, what Gerald went through just now, we also saw that the US market had is still on a pullback. The S&P 500 and the Nasdaq Composite Index are in their fourth consecutive week of decline. So that is a concern now for the market. So let me go through the US index indices first. First up, let's look at the Dow Jones Index. So we have actually breached the 200 days moving average last week. So now we are in a very sort of precautious position now on the Dow Jones Index. If I measure the drop from the peak, which is around the high of end of January or even the peak in early December, that drawdown on Thursday was actually close to 9.79% and close to the 10% correction level, which Dow Jones managed to avoid with a slight bounce on Friday of about 674 points or 1.65%. Okay, looking at how the Dow Jones Index is moving, we notice that the 20 days moving average has cut across the 50 days, which is the green line cutting below the blue line, as well as the yellow line, which is 100 days. This could signal that there is a short-term weakness in the Dow Jones Index right now. On the indicator wise, the MACD is still negative for the Dow Jones Index, but we do see some kind of a slight convergence of the MACI towards the signal line, and that means that the downward momentum that we have been experiencing for the past 4 weeks is starting to show sign of subsiding based on what we saw last Friday. Okay, on the RSI it has also breached the 30-point oversold level last Thursday. And then after that, on Friday, it rebounded somewhere to the 35 points level. So that is a sign that the Dow Jones Index has oversold, and then we have a bounce. So technically speaking, these are signs that we could see at least a technical rebound for the Dow Jones Index because the index is deemed to be in the oversold territory right now, and there is some signs that the downside momentum is actually subsiding. So with that momentum reading, what could be the possible levels that we look at? Of course, if let's say we want to sort of negate the downtrend that we saw in the past 4 weeks, then we need to have a convincing close above the 200 days moving average, which is the red line. If we manage to stay above that, likely the rally that we see last year will likely continue. However, if we are rejected at the 200-point mark, then 200 days moving average, then there will be further downside to come. And that further downside could bring us back to the low on 6th of August last year, around the 38,700 points level or even the 39,000 point handle. Okay, so on the upside, of course, the 20-day moving average will be pushing down. That would add pressure. So followed closely by the 100 days and the 50 days moving average, now at about 43,400 points level. So I think the projection of where the Dow Jones Index will likely move, of course, a lot depends on the FOMC meeting decision this week, and it could likely be range bound between the upside of around the 43,400 level, or even the with the support looking at the 42,000 or 41,900, which is the 200 days moving average level. So this is the range that we are looking at the Dow Jones to move in the next couple of weeks. Okay, so I'll note that down over here. So next, let's move to the broader index S&P 500, which actually moved into the correction territory on Thursday. As you can see over here, when I measure it downward, it actually breached the 10% correction mark, which is it fall close to 10.5% from the peak that we saw on 19th of February. So on Friday, we see a rebound of about 2% or up 117 points. Looking at the indicator wise, we also saw some kind of a subsiding in the downwards momentum according to the MACD indicator. And on the RSI, we saw that on Thursday itself, it actually went into the oversold territory, and then on Friday it rebounded back to the 37 points level, which is now just slightly above the 14 days RSI moving average. So that's a good sign that again we are likely going to see some kind of a technical rebound according to the technical indicators. So the S&P 500 has came quite quite a bit below the 200 days moving average, now at 5740, and we are about 100 points down from here from last Friday closing. So we will need to catch up another 100 points to stay up above the 200 days moving average. And then the resistance could come in at the 50 days and 100 days moving average around the 5,942 points level. You can see that these two lines finding some kind of a confluence over here. So likely the S&P 500 will move in the range, will move back above the 200 days moving average, and then will be capped at the 100 days and the 50 days moving average around the 5,940 points level. So this could be the range that the S&P 500 will be moving in the coming weeks. Lastly, let's move to the more volatile NASDAQ Composite Index. So we also saw a bit of a convincing rebound on Friday as well, up 2.61% or 450 points. Measuring it from the high that we saw in December, the NASDAQ Composite actually retraced now about 14.68%, still a bit about 5% away from a bear market, but then well into the correction territory right now. So Friday rebound, we also saw some of the big tech names like Nvidia and Tesla jumping 5% and 4% respectively. Facebook Meta platform also jumped close to 3%. So there's some recovery in some of the major tech stocks that we've seen last Friday. So value may be starting to emerge right now on the NASDAQ Composite Index, especially on the big tech stocks. So the tech stock, as you can see, dropped to a low of about 17,238 points level, somewhere on the Tuesday and the Thursday levels. And on those 2 days, we can see that the RSI indicator actually went into the oversold territory. And then after that, on Friday, rebounded back up. So that is a sign again that we are seeing a technical, we are likely going to see a technical rebound here on the NASDAQ Composite Index. On the MACD indicator, you can see the past 3 trading sessions we also see that the MACD histogram noting that there is some kind of the downtrend momentum that we see in the past 4 weeks has been subsiding in the past 3 trading sessions, and there's a more convincing sign that the MACD is likely to converge or in the next couple of weeks for the NASDAQ Composite Index to do a rebound. So where are we aiming for the NASDAQ Composite Index to rebound towards? Of course, if we want the long-term rally to continue, we need to go above the 200 days moving average. And when the 20 days moving average, the green line right here, when it comes close to 200 days moving average, hopefully there will become kind of a turn in direction that could confirm that the technical rebound will likely stay for the longer term. And then if on the upper side of the resistance, we can see that the 100 days and 50 days moving average now at 19,200 point level. That will be the key resistance level to watch and could be a point where investors start to get pressured again. So for the next few weeks, we expect the NASDAQ Composite Index to move somewhere using the 200 days moving average as a support, and then cap at the 100 days moving average level of 19,200. So the range could be around the 18,500 levels towards the 19,200 points level on the NASDAQ Composite Index. Okay. So next, let me move to the STI Index. So last week, STI Index, we saw a big gap or a gap down on Tuesday. After that, the STI Index sort of get into a range bound formation. We also saw some of the bank names being pressured, and I see that as an opportunity with very good attractive dividend yields, similar to what Gerald was saying earlier on the REITs as well, 5.4%, around the 5% mark. That is I think that could be a very attractive level for dividends yields for dividend investors looking to capitalize on the recent pullback in the STI. Okay. So the STI, we tested the high somewhere in the February period. We reached a high of 3,951 points. After that, we have a pullback. So it's not a surprise, and you can see that the pullback on the STI index is not as scary as what we see in the US indices. So Singapore STI benchmark index is still a conservative and safe environment which you can invest for the longer term. Okay. According to the indicators, we can see that MACD is showing sign that the downside momentum is subsiding. The RSI, although did not went into the oversold territory, the 30-point mark, similar to what we see in the US, but we can see that it has sort of a tick up as well, and that could be pressured by the 14 days RSI moving average at a 51-point level or the 50-point neutral level. Okay, so I think for the STI right now, according to the RSI, very close to the 50-point neutral mark, is telling us that there is not much of a momentum on the STI. And looking at the candlestick formation this morning, it's showing a doji signal. So likely the STI index will be range bound in the coming few weeks. Okay. So support level that we are looking at, the first support, of course, would be the 100 days moving average, now at 3788. And then the top side, we could probably test the 220 days moving average, the green line at 3,895 points, with the upside at the 3,940, let me see, like 3,951 points. That would be the previous high that we see on the STI index somewhere in the February period. Okay, so STI likely to be range bound around this region. Okay, using the 100 days moving average, 3788, with the top side at the upper bound of the Bollinger Band, or even the high in February at 3,951 points. Okay, so these are the updates that I have this week. Any more key things that we'll be watching, Gerald?
Yes, I think the markets continue to be very volatile at the back of all the news around the tariffs and what is that actually leading to for the US economy. So I think against that backdrop, the US Federal Reserve meeting will definitely be one key event to keep a lookout for, because what the chairman of the Federal Reserve says, what is in the press release, will definitely be closely looked out for.
Yes, definitely agree with you. The Fed actually have the power to control how the market move, as we have seen before during the previous few years. Whenever it increased rates, markets may react negatively. So let me look at the CME Fed Watch 2. Looking at the probabilities, we are still looking at we are not looking at a hike in interest rate. We are still looking at interest rate to stay the same, and possibly there will be a few cuts coming up in the second half of the year. So that could be the catalyst as well. So do keep a lookout for what the Fed decision will be this week, as well as the conference or interview with the Fed chair, to see how we can better navigate the markets this week and next week as well. Okay, so this is all the time that we have this week, and we wish you that to have a safe trading week as usual, and we'll see you again next week in the next weekly market review. Goodbye.
See you.